You are earning 3.5% on your USDC right now. In a few months, that may be a federal crime. Not a violation, not a fine. A crime. Under legislation written in part by the same banks that pay you 0.1% on your savings account and pocket the difference. I have the 376-page OCC document that closes the last loophole Coinbase was counting on. I have the exact wording the banking lobby walked into the White House with on February 10th. And I have the $6 trillion number that sent Wall Street directly to the US Senate and ended any chance of a fair fight. This video will show you exactly what happened, who built it, and 4 moves you can make right now to get ahead of it. But the moment you understand the full architecture of what was just done to your money, you're going to be angry, and you should be. You were promised a pro-crypto revolution. Here's what you got instead. Let's rewind to January 2025. The crypto community was euphoric. Donald Trump had just won the White House. He'd accepted Bitcoin donations during the campaign. He'd talked about a U.S. Bitcoin strategic reserve. His own family had launched crypto projects. His administration's first days were filled with executive orders signaling that America was open for business on digital assets. Crypto Twitter was calling it a golden era. Influencers declared that the government had finally flipped to our side. And then came the legislation. The Digital Asset Market Clarity Act, the Clarity Act, was supposed to be the crown jewel of this pro-crypto revolution. It passed the House on July 17, 2025, with a bipartisan vote of 294 to 134. Massive margin, real momentum. For the first time ever, Congress was drawing clear jurisdictional lines. SEC handles investment assets, CFTC handles digital commodities. Finally, the regulatory clarity the industry had been begging for since 2017. But then it hit the Senate. And that's where the story turns. Because sitting in that Senate chamber were the most powerful banking lobbying groups in American history. J.P. Morgan, Bank of America, Wells Fargo, the American Bankers Association, representing over 100 financial institutions, had already spent $56.7 million on lobbying in 2025 alone. Not specifically on the Clarity Act, just in general lobbying every year. A permanent war chest defending their turf. And they had identified one specific feature of the stablecoin economy that terrified them more than anything else. Yield. The ability for you, a normal person sitting at home, to earn 3.5% annually just by holding USDC on Coinbase. Think about what that means for a second. Your savings account at Bank of America right now pays you roughly 0.1%. 0.1%. Meanwhile, Coinbase was offering you 3.5% on USDC, backed by US Treasuries, with full liquidity, no lockup, no fees, and you remain in complete control of your assets. The banks didn't just dislike this, they were terrified of it. How terrified? Bank of America CEO Brian Moynihan went on his company's earnings call in January 2026 and dropped a number that made Wall Street's jaw drop. He cited U.S. Treasury Department studies warning that up to $6 trillion in bank deposits, that's 30 to 35% of all U.S. commercial bank deposits, could migrate out of the traditional banking system and into yield-bearing stablecoins if Congress didn't act. $6 trillion. For context, that number is larger than the entire GDP of Japan. It represents the core funding base that banks use to issue mortgages, small business loans, car loans, and every other financial product that touches the real economy. When Moynihan spoke, it wasn't just a warning to investors. It was a direct political message to the U.S. Senate. Protect us, or the entire lending system is at risk. And the Senate listened. The stablecoin yield provision, the ability for platforms like Coinbase to pass Treasury returns back to regular holders, became the central battlefield of the Clarity Act negotiations. And not just a battlefield, a kill switch. Because here's the truth that almost nobody in the mainstream media is telling you clearly. The fight over stablecoin yield isn't a technical disagreement about financial structure. It's a structural war over who controls the yield on American savings. Right now, banks take in your deposits at 0.1%, invest them in 4 to 5% Treasury instruments, and pocket the difference. That's called the net interest margin. And it's worth hundreds of billions of dollars in annual profits to the U.S. banking industry. Stablecoin yield threatened to collapse that model entirely. Because if a decentralized protocol, or even a regulated platform like Coinbase, can pass Treasury yields directly to ordinary holders, bypassing banks entirely, then why would anyone ever keep money in a traditional savings account again? The answer is, they wouldn't. And that is why we are at war right now. But before I show you the 3 secret White House meetings where this deal was cut, I want to see who is standing with me today. This isn't just about US policy. This is a global fight for the future of money. I want to see our footprint. Drop a comment right now. Tell me your city and the exact local time you're watching this. Is it sunrise in Miami, high noon in Chicago, or are the lights still on in Los Angeles, Austin, or New York? Let me know. And if you believe that transparency is the only way to beat this betrayal, hit the like button and subscribe. It's the only way we signal to the algorithm that we want signal, not the banking lobby's noise. Now, let's look at February 2nd, the day the bankers walked into the White House with a kill switch. Here is a chart showing USDC 3.5% versus bank savings 0.1%. By late 2025 and into early 2026, more than $300 billion in stablecoins were already in circulation. These assets were already processing more annual transaction volume than Visa and MasterCard combined. It was $27.6 trillion versus Visa's $15.7 trillion in 2024. The shift had already begun, and the banks didn't just want to slow it down. They wanted to kill the yield feature entirely before it became unstoppable. And so began the meetings. 3 White House meetings, 0 deals, and a 376-page playbook that says it all. Let me walk you through what actually happened, step by step, because the details matter. February 2, 2026. First White House meeting. The Trump administration's Crypto Policy Council, led by Patrick Witt, convened a closed-door session. He is the executive director of the President's Council of Advisors for Digital Assets and brought bank executives and crypto leaders together. The crypto team showed up ready to negotiate with representatives from Coinbase, Ripple, and Venture Fund at 162. They came prepared with compromise proposals, understanding that some restrictions were coming. They just wanted to preserve the core principle. Platforms like Coinbase should be able to offer rewards to stablecoin holders. The banks came with something else entirely. According to a copy of their document obtained by CoinDesk, the banking negotiators arrived with a principles document. It called for a complete, total zero exceptions ban on stablecoin yield. Their language was sweeping, prohibiting any form of financial or non-financial consideration to a payment stablecoin holder. This applied to the purchase, use, ownership, possession, custody, holding, or retention of a payment stablecoin. Read that sentence again. Any form of financial or non-financial consideration. They weren't just banning interest payments, they were trying to ban rewards programs and loyalty points. They targeted cashback equivalents, anything that could possibly make stablecoin holding more attractive than keeping money in a bank. The meeting ended with no deal, though both sides called it constructive. February 10, 2026. Second White House meeting. Same table, same tension. The crypto side made proposals, but the banking side held firm, no deal. White House crypto advisor Patrick Witt publicly called the discussions productive. He predicted a compromise was coming, but behind closed doors, sources told CoinDesk the atmosphere was far less optimistic. February 19, 2026. Third White House meeting. This time, something shifted, but not in the direction crypto holders hoped. The White House itself proposed a middle ground framework. Patrick Witt outlined language that would allow rewards only for activities or transactions. This meant you could theoretically earn something by spending your stablecoins or interacting with protocols, but not, and this is the critical word, not balances. No more earning yield just for holding stablecoins. Witt even gave this arrangement a dismissive label in a public Yahoo Finance interview. He called passive balance-based yield idle yield, as if your money just sitting in your wallet, earning a return, was somehow wasteful or illegitimate, as if the problem wasn't the banks paying you nothing, it was you expecting something. Let me be completely clear about what this means in practice. Right now, if you hold USDC on Coinbase, you earn 3.5%. Coinbase takes your USDC and deposits it into money market instruments backed by US Treasuries. Those instruments generate roughly 4 to 5% annually, and Coinbase passes most of that back to you. That's what yield is. That's the mechanism. That's what the White House just proposed eliminating. Under the new framework, if you want to earn anything at all, you'd need to actually do something. You would have to make transactions or interact with approved activities to unlock any kind of reward. The passive income stream you may currently rely on? Gone. And then came the regulatory hammer that nobody saw coming. The regulatory hammer, the OCC proposal. February 26, 2026, the OCC proposal. While the White House meetings were still ongoing, the Office of the Comptroller of the Currency dropped a bombshell. The federal regulator that oversees national banks released a 376-page proposed rulemaking to implement the Genius Act. This stablecoin-specific law had already passed, but the industry assumed they still had a loophole. The Genius Act banned issuers from paying yield, meaning Circle could not directly pay you interest on USDC holdings. However, platforms like Coinbase, third parties holding your USDC, believed they could still offer their own rewards programs. Plus one. This was the industry's escape hatch and the business model keeping Coinbase's stablecoin revenue intact. The OCC just closed that loophole entirely. In its 376-page document, the OCC proposed an anti-evasion framework. This language was designed to challenge third-party arrangements where rewards are passed through an intermediary. The OCC stated that close financial ties between issuers and crypto platforms make evasion highly likely. They argued that issuer payments would simply be routed through an intermediary to circumvent the Genius Act's prohibition. Translation: even if you are not the issuer, if you are closely connected to them, your rewards are at risk. The OCC reserves the right to challenge your rewards program as an attempt at evasion. Industry insiders who spoke to CoinDesk called it a dark cloud over the entire stablecoin model. One former FDIC lawyer acknowledged the language is troubling, but noted there may be some play in the joints. This means the fight is not entirely over, but the direction of travel for the industry is unmistakable. The OCC proposal also opens a 60-day public comment window for feedback. Industry groups and Coinbase will fight it, but as one analyst put it bluntly, it's all but done. Coinbase is the largest U.S. exchange and the company that put Bitcoin on Wall Street's balance sheet. They spent $25 million funding the Fair Shake crypto PAC and helped elect 12 of the 22 Clarity Act sponsors. Despite this, Coinbase was essentially told, get on board or get left behind. Brian Armstrong had already publicly withdrawn support for the Clarity Act back in January. He called provisions that would kill stablecoin rewards materially worse than the current status quo. He explicitly called out the banks for using the bill to ban their competition. He was right, but it did not matter, because the White House was not on his side anymore. Let me show you the scoreboard so far and talk about who is actually winning and losing. The winners. Traditional banks are the obvious victors in this scenario. If passive stablecoin yield is banned, the threat of $6 trillion in deposit flight evaporates. Bank of America, JP Morgan, and Wells Fargo get to keep their net interest margin. The competitive threat from crypto yield platforms is legally neutralized by making the competition illegal. Visa and MasterCard are also quietly winning as stablecoins get pushed into activity-based rewards. As assets are spent rather than held, that spending will flow through existing card networks. Visa has already reported multi-billion-dollar annualized stablecoin-linked card spend. MasterCard has partnered with Circle, Paxos, and PayPal to enable stablecoin settlement across their network. They do not need to kill stablecoins. They just need to ensure they cannot replace bank deposits. That battle is now won. The game may be decided. Your next move isn't. Before I go further, everything I'm about to share is for educational purposes only. This is not financial advice, and I am not your financial advisor. Do your own research, consult a professional, and make decisions based on your own situation. What I'm giving you here is a framework for thinking, not a prescription for acting. With that said, here are 4 concrete frameworks for people who are paying attention right now. Move 1. Audit your exposure. Before the window closes. This is not optional. Do it this week. If you are currently earning passive yield on USDC, USDT, or any dollar-pegged asset through a US licensed platform, Coinbase, Kraken, or any regulated exchange, that income stream has a countdown on it. The OCC's 60-day comment window is already running, and the March 1st White House deadline is passed. The architecture to eliminate this is already built. The educational takeaway here is simple. Understand your dependency. How much of your monthly income depends on passive stablecoin yield? If that number goes to 0 tomorrow, what does your financial picture look like? Most people haven't asked that question. Asking it is the first move. Move 2. Understand how DeFi fills the gap. Here's the irony the regulators may not have fully considered, and it's worth understanding as a structural concept. The yield ban, as currently written, applies to regulated U.S. licensed platforms. It does not, and cannot, by definition, apply to permissionless, decentralized protocols operating outside U.S. jurisdiction. The OCC can regulate Coinbase, but it cannot regulate Ethereum. The Senate Banking Committee can write language targeting Circle, but it cannot write language targeting a smart contract with no CEO, no headquarters, and no employees. Historically, when regulated environments suppress returns, capital migrates toward unregulated alternatives. That's not a prediction. That's a pattern that is repeated across every major financial regulatory cycle in modern history. Understanding how decentralized protocols like Aave or Compound work, their mechanics, their risk profiles, and their actual yield structures, is valuable education regardless of what you decide to do with that knowledge. The migration wave, if it happens, will reward people who understood the landscape before it started. Move 3. Study Bitcoin's role in a yield-restricted environment. This one is counterintuitive, so stay with me. Bitcoin has no yield, it pays nothing. There's no interest, no rewards program, and no treasury spread to pass along. From a passive income perspective, Bitcoin is completely useless. And yet, understanding why this regulatory moment structurally strengthens Bitcoin's position is one of the most important things a crypto holder can learn right now. Here's the concept. Stablecoins were targeted precisely because they threatened to compete with bank deposits. They offer dollar-denominated savings with yield. A savings account, but better. Bitcoin doesn't do that. Bitcoin isn't trying to be a savings account. It's a scarce, non-sovereign, non-censorable asset with a fixed supply of 21 million coins. The question worth studying is this: what happens historically to the price of an asset that governments cannot regulate, freeze, or ban? Specifically, in an environment where they are actively eliminating alternatives to traditional banking. That's not a recommendation, that's a research question, and the historical data on Bitcoin's behavior during periods of financial repression is worth understanding deeply. Move 4. Understand the political lever and how it works. This is the move most people will skip, yet it is the one with the longest time horizon, and potentially the most leverage. The Fairshake Passy has $193 million ready to deploy in the 2026 midterms. Coinbase has committed $25 million, Ripple another $25 million, and Andreessen Horowitz $24 million. 12 of the 22 Clarity Act sponsors in the House were already backed by this network. The bank spent $56.7 million on general lobbying in 2025. The crypto industry is approaching the ability to match that, but only if the community stays engaged and treats this as an ongoing process, not a done deal. The Stand with Crypto campaign has already sent 250,000 messages to Congress. Treasury Secretary Bessent has publicly flagged the 2026 midterms as a legislative deadline. This means there is a real window where political pressure can still shape the final language of this bill. Understanding how that process works, how PAC money flows, how legislative language gets amended, and how public comment periods function, is civic education. It directly applies to the financial ecosystem you're operating in. The 60-day OCC comment window is open right now. That is a formal, legal mechanism for public input. Whether you choose to use it is your decision, but knowing it exists is the first step. The educational takeaway across all 4 moves. These 4 frameworks share one underlying principle. Informed decisions require understanding the environment before it changes, not after. The regulatory direction is clear, and the timeline is compressed. The structural shifts from regulated yield to DeFi, from stablecoins to harder assets, and from passive income to active participation are already in motion. What you do with that understanding is entirely your decision, made in consultation with people qualified to advise you. What I've given you here is the map. The route is yours to choose. This isn't just about yield, it's about who controls your money. I want to zoom out for a moment because the stablecoin yield debate is really a microcosm of a much larger question. The promise of cryptocurrency, its core value proposition, has always been financial sovereignty. The ability to hold value, transact, and earn returns without requiring permission from a bank, a regulator, or a government. What's happening with the Clarity Act is a direct collision between that promise and institutional structures. These structures control the traditional financial system and are now reacting to the threat. Stablecoins have surpassed $300 billion in market cap. They processed $27.6 trillion in transaction volume in 2024, already more than Visa. By 2030, the U.S. Treasury Secretary himself has projected that stablecoin supply could reach $3 trillion. Bloomberg projects stablecoins could handle 25% of all cross-border flows by 2030, representing a $55 trillion annual opportunity. This is not a niche product anymore. This is financial infrastructure at systemic scale. And the moment it became systemic, the moment ordinary people started earning 3.5% on their savings through USDC instead of 0.1%, the institutions came for it, not with better products, not with higher rates, and not with innovation. They came with legislation. The banks spent $56.7 million lobbying Congress in 2025. They showed up at White House meetings with a principles document calling for a total ban. They testified before the Senate Banking Committee about deposit flight and systemic risk. They did exactly what incumbent industries always do when faced with superior competition. They used political power to eliminate the threat legally, and so far, it appears to be working. Here is what I want you to take away from all of this. The Clarity Act, in its current form with the yield ban intact, is not a pro-crypto bill. It is a banking protection bill with a crypto-friendly wrapper. It divides SEC and CFTC jurisdiction in ways the industry wanted and provides clarity on asset classification. But on the one point that matters most for ordinary holders, the ability to earn a fair return on savings without a bank, it sides with Wall Street. That is the betrayal. It is not a betrayal from Bitcoin, Ethereum, or the technology itself, which continues to function exactly as designed. The betrayal is political and institutional, and it is happening right now. Your job as a crypto holder is to understand that this is the environment you are operating in. It is not the environment we were promised, or the utopian narrative where the government lets decentralized finance flourish unimpeded. The real environment, powerful incumbent financial institutions using regulatory capture to protect their business models. The technology marches forward regardless of these maneuvers. Bitcoin does not care about the Clarity Act. Ethereum does not care about Patrick Witt's idle yield language. The underlying protocols that enable permissionless, trustless, uncensorable finance are not subject to Senate Banking Committee jurisdiction. The Clarity Act can regulate Coinbase. It cannot regulate Ethereum. That distinction is going to matter more and more as this decade progresses. Let me close with 3 clear practical actions. 1, audit your stablecoin yield exposure. If you're currently earning passive yield on USDC or other regulated stablecoins through a US licensed platform, understand that this income stream may be disrupted or eliminated in the coming months. Don't wait for the final rulemaking to assess your exposure. Do it now. 2, study the DeFi yield landscape. The yield that disappears from Coinbase doesn't evaporate from the universe. It shifts to decentralized alternatives. Protocols like Aave, Compound, and newer DeFi infrastructure operating outside regulated US platforms will likely see increased capital inflows. Understand these alternatives, their risks, and their potential. 3, treat Bitcoin as the core, not the speculation. In an environment where the US government is actively restricting yield alternatives and funneling capital back toward traditional banks, non-custodial, non-sovereign hard assets look more attractive, not less. If you've been underweight Bitcoin in favor of yield-bearing stablecoins, this regulatory environment is your signal to rebalance. And finally, this is important, stay engaged politically. The Fair Shake PAC has $193 million ready to deploy in the 2026 midterms. Your voice, your vote, and your support for crypto-friendly candidates in November 2026 matters more than it ever has. The game may have been decided in this round, but the series isn't over. The game is already decided. That's what they want you to believe. They want you to see the OCC's 376 pages and the White House's March 1st deadline. They want you to see the banking lobby's total ban principles, document, and give up. Don't give up. Understand the game and play it better than they expect. Remember, every time a powerful institution uses regulation to kill a competitive threat instead of innovating its way past it, it's an advertisement for why the alternative needs to exist. The Clarity Act may ban stablecoin yield. It cannot ban financial sovereignty. But before I go, I want to talk to you specifically. The average person watched less than 5 minutes of this video before clicking away for something easier. But you stayed for the whole investigation. You sat through the banking lobby's secret documents, the regulatory data, and the history. That means you're not just a trader, you're a researcher. You have the attention span that Wall Street and the banking lobby count on you not having. You are officially part of the 1% who actually knows what's happening behind the curtain. If you made it to this final second, I want you to leave a comment with these 4 words. I see the machine. And if this video helped you understand the real cost of this legislation, drop the word betrayal right next to it. I read every single one of those, because those are the people this channel was built for. Hit the like button and subscribe if you want me to keep going deeper on this. This story is far from over. Stay vigilant. I'll see you in the next one.